Alright, so the last video we talked about some of the different types of credit, some of the advantages and disadvantages of using credit. So we'll start off this video just talking about kind of recapping what we went over. So we had non-installment credit, we had installment credit, and we had open-end or revolving credit as the three types that we looked at. And then we also talked about the advantages and disadvantages. So using credit allows you to purchase large items that you don't have the money for right now. It helps you build your credit score, helps you show the world that you can be a responsible consumer, responsible borrower. But obviously then there's disadvantages. People can misuse and mismanage the types of credit that they have. They can easily spend more than they make or more than they have because it's not actually their money that they're spending. So that's definitely the big issue with credit. So we want to make sure that if we're going to use credit, we can use it responsibly and that we know how to use it. What we're going to talk about in this video, we're going to talk a little bit about credit scores and a couple other different points. So when you look for a credit card, and there's an activity that you'll do where you will actually compare a couple different cards from some different companies against each other. Some things that you want to know or look for. Sometimes you'll see this APR. What that stands for is annual percentage rate. All that is the interest rate. It's just another way of saying interest rate. So that's the amount of interest that you'll have to pay if you don't pay off your credit card in full. Sometimes credit cards have annual fees just to use them. Sometimes it's $20, sometimes it's $100, sometimes it's more. Your credit limit is how much money you can spend on that card, how much you can charge on the card. There's all different types of things that you can use to compare cards, and if you look at that assignment, you can kind of see the chart that I have filled out, or the chart that I have that you guys will fill out to compare the different cards. And then this last point here, cashback. Most cards will offer some sort of incentive for you to use them. Cashback is a very common one, so some cards will give you 1% cash back on everything that you purchase, everything that you spend. And what that means is that for every dollar you spend, you get 1 cent back in money that you can use. So, or let's say if you spend $100, you get $1 back is basically what that would be. So some cards offer incentives for you to use them. Sometimes you'll see you can get mileage with airlines. You can get money back for paying for gasoline. Every card kind of has their own incentive program that they have. So you can go to this Capital One site when you do the activity. Something that I want to bring up, this law or this act associated with credit cards is called the Equal Credit Opportunity Act. What that does is it prohibits anybody from denying you credit based on your gender, your age, your national origin, your religion, anything like that. You cannot be discriminated against from using credit by any of those things. What they will discriminate against you with is your credit score, and that's what we're going to talk about and focus this video on. Like I said earlier, your credit score affects everything that you do in your adult life, so you want to make sure that you build your credit score up and then you keep it up, because that is how people will decide if they want to loan you credit or not. Okay, so your credit score is basically a number that assesses your credit worthiness. Like I mentioned before, it is your GPA when you get out of school. So as a student, if I have a 4.0 student and I have a 2.0 student, I can make assumptions about both of those students. I can assume that the 4.0 student is probably going to do well in my class. I can assume that they're probably going to do their homework. I can assume that they're probably going to do well in their other classes. The 2.0 student, I can probably assume that some of the times they're going to do the homework, some of the times they're not. They're probably going to end up with a C or B in my class. Your credit score is the exact same thing. The lower your score is, the worse it is. The higher your score is, the better it is. So if I have somebody with an 800 credit score and somebody with a 500 credit score, I can assume that the person with the 800 credit score is going to pay me back. They're going to pay me back on time. They're going to make smart decisions with their money. And I can assume that the person with the 500 credit score is going to pay me back some of the time. They might not be as good with managing their money, and they might not make great decisions all the time. So your credit score really, really, really affects everything that you will do in your life. And how they calculate a credit score, we will go over in a couple slides. But you'll see sometimes this Fair Isaac Corporation, or FICO, you'll kind of see that synonymous or interchangeable with your credit score, your FICO score, your credit score. They mean the same thing. So you can see this chart on the right side of the screen, the percentage of the American population that has a credit score within each of those categories. The higher you are, the better your score is. So you can see a lot of people in that 700 to 850 range, which is where you want to be. So this is how your credit score is calculated. There's 5 different components to it. And the one that has the most weight is your payment history. So your credit score is going to show me or tell me, are you somebody who I can trust lending money to? So obviously the category with the most weight to it is going to be your payment history. Have you paid people back over time? Do you make on-time payments? Do you have loans or credit that you never paid back? That's going to make up a huge part of your credit score. After that, the other categories that make up your credit score, the amounts that you owe. Are you somebody who has tens of thousands of dollars of credit that you owe? Are you somebody who has maybe just a few $1,000s, which would probably be a little bit better? But they're going to take that into consideration for your credit score. Are you somebody who takes out huge loans very often, or are you somebody who uses loans and credit wisely? After that, they'll look at how long have you used credit for. If you're a younger person, obviously you won't have a very long credit history, so that'll bring your score down a little bit. But as you use credit and go further on in your life, that will start to grow your credit score. And then the last 2 things that they look at is new credit. So how often, when was the last time that you opened a new credit account? And then lastly, what are the types of credit that you use? Do you have a ton of credit cards? Do you have a ton of loans? Do you have a little bit of non-installment credit, a little bit of installment credit? You want to try to have a mix, a variety of all the different types of credit. But you can see, obviously, the top 2 things, 65% of what makes up your credit score, your payment history and the amounts that you owe. So you want to make sure you're making on-time payments and that you're not late with your payments. And you want to make sure that you're not borrowing huge sums of money. Okay? And we can see right here how your credit score impacts really everything in your life. So on this chart, we see 3 different people with 3 different credit scores. One person has a 730 credit score. One person has a 660. One person has a 590. You will get a better interest rate simply for having a better credit score. Okay, so we see that top person there, 730 credit score. They're going to get a car loan. The interest rate's only going to be 6%. So their monthly payment, $450. Compare that to the lowest person on that chart. Their credit score is $590, or excuse me, their credit score is $590. Their monthly car payment is over $500. Okay, so that's about a $60 increase every single month. So you multiply that over 12 months, you multiply that over the course of a lifetime, that adds up to be a lot of money over time. So you want to do yourself a favor, build your credit score, keep it high from the beginning. Okay, so right here in this chart, we see over $2,000 difference in a 3-year period. Like I said, imagine that over the course of your entire life, 60, 70 years. That's going to make a big difference. You want to have a great credit score. Okay, so to keep a good credit score, you have to have good credit history, and you have to maintain that. You have to make sure that you're checking on it. You have to make sure that you are not borrowing huge sums of money. You have to make sure that you're paying on time. All of these things will help you maintain a good credit history and a good credit score. Okay, so there's some tips on the right side of the screen there of what you can do to maintain your good credit score. And a credit score is going to affect, like I said, just about everything that you do. the insurance rates that you pay. If you can get a job, people will look at your credit score. If you can't handle your own money and you have a poor credit score, why would I hire you to manage money at my store or my business? If I'm a landlord and I want to rent a house maybe to you and you have a poor credit score, well, if you can't pay your credit card bills on time, you're not going to pay your rent on time, so I'm not going to rent you this house. Everything that you do, people will look at your credit score to assess if you will be a trustworthy person or not. Okay? These credit bureaus, there's 3 credit bureaus in the United States that keep track of all your credit history and credit payments. Okay, these credit bureaus are called Equifax, TransUnion, and Experian. You're going to want to remember those 3 names. These bureaus record and report every credit piece of information in your history. How many payments you have overdue, how many payments were on time, how many credit agreements do you have, how many credit accounts do you have open, how much are they worth. These 3 bureaus are recording all that information, and they keep it in your credit history that records and calculates your credit score. Okay, so you want to make sure that you are checking with these 3 bureaus to make sure that your credit score is accurate, that it's where it's supposed to be, that it's not going too low, and that you're doing the right things. Okay, so these are the 3 bureaus. You want to make sure you remember them. Equifax, TransUnion, and Experian. These 3 bureaus that calculate and collect all of the credit information in your history. Okay? And you can look up your credit report. Since it's your report, I'm sure everybody's seen the commercials like freecreditreport.com, and I think there's a few more. You get free. You do not have to pay for your credit report. You should get at least one free one every year because that's what you are entitled to. So your credit report is basically just a report that shows your credit history from those 3 bureaus that we just talked about, and it shows when you were on time, when you were late, what kinds of accounts do you have, etc., etc. Okay, so you want to make sure that you are checking your credit report and staying up to date with that. Okay, I'll share a quick story that I usually share in class about credit reports and credit history and why it's important to keep track of that stuff. So a few years ago, I was checking my credit score through my credit card company, and I noticed a couple loans on there that I had not taken out, and I was kind of wondering, there was about $10,000 worth of stuff, and I was like, well, this isn't mine. I think they messed up. So what I had to do is I had to go to TransUnion, one of those credit bureaus, and I had to file a report with them that I thought some of their information was inaccurate. And so what ended up happening was some loans that my dad had taken out ended up on my credit history, my credit report, and it was inaccurate. So I had to create an account, I had to go through, file a claim, tell them that it was wrong. They had to go back and review it, and it was this whole big thing that happened. I was lucky because my dad pays everything on time. He wasn't late, so it didn't affect my credit score at all. But you can imagine what would have happened if I wasn't so lucky. Let's say my dad missed a few payments on that, and it affected my credit score negatively. That would have been a bigger issue for me to deal with. And you'll see that happen a lot of the times is maybe a parent with the same name as you or a family member with the same name as you has some poor credit history that accidentally gets put on your credit report. So that story just kind of really tells you the importance to make sure that you stay up to date and that you check your credit report, you check your credit score routinely to make sure that it's where it needs to be, make sure that all the information on it is accurate, because people make mistakes, and people, right, just human beings, are the ones that are calculating your credit report and your credit score. So you need to make sure that there's no mistakes on there, there's no errors. You got to stay up to date with that stuff. Okay? So make sure you build a credit score, build it up high from the beginning, and you keep it there, because it's one of those things that's easy to dig yourself into a hole, and it's very hard to get yourself out of it. So you want to make sure that you keep track of that stuff. It's very important.